What if I told you that the average return on your investments means almost nothing once you retire? I know that sounds wrong. Stay with me. Two people retire with $500,000. Same portfolio, same mix, 60% stocks, 40% bonds. Both pull out $25,000 a year adjusted for inflation. Same fees, same picks. And the market gives them the exact same average return over 30 years. One of them finishes retirement with over $4 million still in the bank. The other goes broke before 80. Same average return, opposite outcomes. Here's a question for you. What do you think matters more for your retirement? How much the market returns over 30 years, or when those returns show up? Think about that, because most people get this completely backwards. If you're in your late 50s or early 60s, maybe 5 or 10 years from retirement, you've probably done the math in your head. You've looked at your portfolio and thought, is this going to be enough? That question is exactly why this video matters. By the end of it, you'll know the one thing that actually decides whether your $500,000 lasts a lifetime or runs out early. And you'll have a 3-part defense you can start building today, no matter what the market does next. Quick note. I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. So why did those two retirees end up in completely opposite places? It comes down to something called sequence of return risk. And once you understand it, you'll never look at retirement planning the same way. Sequence of return risk, your first 5 years. Here's the idea in plain English. When you're saving for retirement and your money just sits there growing, the order of the returns doesn't matter. Good year, bad year, good year. After 30 years, you end up in the same place regardless. But the moment you start pulling money out, everything changes. If the market drops 30% in your first year of retirement and you still need $25,000 to live on, you're selling shares at rock-bottom prices. Those shares are gone. They never recover. They never participate in the next bull market. It's dollar-cost averaging in reverse. Here's the myth. If the average return is 8 or 10%, your retirement is safe. Here's the truth. Average returns mean almost nothing once you start withdrawing. It's the order those returns arrive in that decides everything. Retirement researcher Wade Pfau studied this and found something that should stop every pre-retiree in their tracks. The compounded return in just the first 10 years of retirement explains 77% of your final outcome. 77%. Let me show you what that looks like in the real world. Take a guess. Someone retired in 1966 with $500,000. They earned a 9.67% average annual return over 30 years. Sounds great, right? What do you think happened? They went broke. A healthy 30-year average, and they still ran out of money in about 24 to 28 years because inflation ran 8 to 12% in those early years. The 1973-74 bear market cut stocks by nearly 48% in real terms. The first 15 years delivered roughly negative 0.2% real annually. The math looked fine on paper, but the sequence was wrong. Now compare that to someone who retired into a good sequence, like 1982. Same starting balance, same 60-40 mix, same withdrawal. The market handed them a generational bull run right out of the gate. Those retirees ended with a median of 2.8 times their starting principal. Best cases, over 6 times.
Same average return over 30 years. Completely opposite outcomes. And here's the key number. The average bear market lasts about 9.6 months from peak to bottom, but the full recovery, back to the previous high, takes roughly 2.5 to 3 years. That gap is the danger zone. So now you know what the risk is and why it matters, but here's the part most people never hear. This risk has a defense. 3 moves, 1 system, and you can start building it right now. The 3-part retirement withdrawal defense. These 3 moves aren't 3 separate strategies. They're one system. Each piece covers a specific gap. Part 1 reduces your exposure before the danger window opens. Part 2 buys you time during the window. And Part 3 tells you which money to spend and when, so you never sell stocks at the worst possible time. Part 1. The glide path. Most people make one of two mistakes. They either stay 100% in stocks right up until retirement, fully exposed to a crash on day one, or they panic at 63 and dump everything into bonds overnight. Now they've killed the growth they need to last 30 years. Smart pre-retirees do something different. 5 years before retirement, they start shifting gradually, about 4 percentage points per year. If you're at 80% stocks 5 years out, year 1 you go to 76, then 72, then 78, then 64. By retirement day, you land at 60-40. Powell and Kitces published research in the Journal of Financial Planning showing that glide paths starting more conservative actually reduced both the chance and the size of failures. The key is gradual, mechanical, calendar-driven, no emotion. Part 2. The income floor. At the moment you retire, set aside 2 to 3 years of expected withdrawals in a separate pool. Not stocks, not long-duration bonds. Cash, money market funds, short-term T-bills, stuff that doesn't lose value when the market gets crushed. Why 2 to 3 years specifically? Because that's roughly how long the average bear market takes from prior peak to full recovery. If you have that cushion and stable assets, you can fund your entire lifestyle from the floor while stocks recover. You never have to sell at the bottom. And right now, July 2026, that floor actually pays you something decent. Vanguard's money market fund is yielding around 3.5%. Short-term T-bills are paying 3.8 to 4%. 2-year treasuries are around 4.2%. On a $25,000 annual withdrawal, your income floor is about $50,000 to $75,000 parked where the stock market can't touch it, and it's earning 3.5 to 4% while it sits there. Refill rule, simple. Any year where the S&P finishes positive and your stock portfolio is at or above where it started the year, top the floor back up from equities. Sell into strength, mechanical, no emotions. Quick question before we move on. If you're within 10 years of retirement, have you started building your cash floor yet? Yes or no? Drop it in the comments. I read every single one. Part 3. Bucket sequencing. Organize your portfolio into 3 buckets. Bucket 1 is your income floor, the cash and T-bills we just covered. Bucket 2 is income-producing investments, dividend ETFs like SCHD, currently yielding about 3.3% with a 0.06% expense ratio in 14 to 15 consecutive years of dividend growth, or VYM, about 2.2% yield, 0.04% expense ratio, roughly 550 holdings. These throw off cash naturally without you selling a single share. Bucket 3 is equity growth, VOO for the S&P 500 at just 0.03% expense ratio, VTI for the total U.S. market, about 3,600 holdings, or QQQM for NASDAQ 100 growth. More volatile, but this is the engine that keeps your portfolio alive for 30 years.
The drain rule is straightforward. Good market year, draw from bucket 3. Sell stocks at high prices, use the gains to refill bucket 1. Flat year, draw from bucket 2. Dividend income covers the withdrawal. Don't touch equities, don't touch the floor. Bad year, draw entirely from bucket 1. Don't touch anything else. Let the floor do what it was built for. Now, I want to be honest about something. Researcher Michael Kitces studied bucket strategies and found that mathematically, a disciplined bucket approach produces the same result as simple total return rebalancing at the same allocation. The lines literally overlap. So, why use buckets at all? Because the real value is behavioral. When the market drops 30% and your portfolio is bleeding, having 2 years of safe money sitting right there changes how you react. You don't panic. You don't sell at the bottom. You wait. The glide path and the income floor do the mathematical work. Buckets are your discipline insurance, and that matters more than most people think. So, that's the system, but there's one more piece most people get wrong: the withdrawal rate itself. The 5% withdrawal rate truth. The word is flexibility. You've heard of the 4% rule. William Bengen created it in 1994. He tested every 30-year retirement period going back to 1926 and found that 4% of your starting balance, adjusted for inflation each year, survived every single one. But here's what's interesting. Bengen himself updated his research in 2025. With broader diversification, he raised his worst-case floor to 4.7% and his estimate for current retirees, 5.25% to 5.5%. The person who invented the 4% rule now says 5% is reasonable. But Morningstar disagrees. Their December 2025 analysis puts the safe starting rate at 3.9% for a 90% success target. So, who's right? Honestly, they both are, because the answer isn't a single number, it's a system. When researchers tested dynamic withdrawal strategies like the Guyton-Klinger guardrails, where you raise spending 10% when your portfolio grows past a ceiling and cut 10% when it drops below a floor, the sustainable starting rate jumped to 5.7%. 5% works if you have the defense system in place and you flex with the market. Spend a little more in good years, pull back in the bad ones. Mechanical, calendar-driven. A rigid 5% marched straight through a bad early sequence. That's exactly the recipe the broke retiree followed. 5% with flexibility in a defense system, that's the recipe for millions. So, let me put this all together for you. Build your retirement income defense today. Say you're 59, you've got $500,000 saved. Retirement is 5 or 6 years away. Here's exactly what you do. Step 1. Start the glide path. If you're at 80% stocks, reduce your equity allocation by about 4 percentage points each year. By 64, you're at roughly 60-40. Gradual, mechanical, no panic moves. Step 2. Build the income floor. 2 years of planned withdrawals, about $50,000, into a money market fund yielding 3.5% or short-term T-bills at 3.8 to 4%. This money sits outside the stock market, where nothing can touch it. Step 3. Organize the rest into buckets. Bucket 2 gets dividend ETFs like SCHD and VYM for income. Bucket 3 gets growth funds, VOO, VTI, or QQQM. Set the drain rules, follow them. Step 4. Set your guardrails. If your portfolio drops 20% from its high, cut spending 10%. If it grows 20% above target, raise spending 10%. This turns a fixed 5% into a flexible system that survives anything. And remember this, the market's average doesn't decide your retirement, your first 5 years do, and those you can prepare for. If someone you know is within 10 years of retirement and doesn't have this defense built, send them this video right now. What's your biggest concern about the first 5 years of retirement? Tell me in the comments. I'm curious what keeps you up at night. And if you're building income from your investments and want a real plan that holds up when the market doesn't, subscribe to this channel. I'm here every week with the math, the data, and the plan.